liabilities, okay, let's say borrowings or fixed deposit that customers have, have saved with us, okay. So they, as we saw the gap analysis, during the gap analysis, it can, we need to, in the short term, we need to maintain enough capital buffers that can incur or absorb that gap, okay, that gap between the assets that we hold and the liability long term, to absorb any risk that may occur. For example, interest rate risk may impact or may expose, for example, our risk sensitive assets and liabilities, okay. Risk sensitive assets and liabilities, for example, customer deposits are not demanded, okay. So to do a little bit of not a little bit, we need to do thorough forecasting and monitoring. You remember yesterday we talked about that. From previous from, for example, even recent movements, we should be able to do projected cash flows. For example, we should be able to say that around the third quarter of an economy, for example, this and this much cash reserves is needed in the economy in circulation. Therefore, the RMB will, in this case, the Reserve Bank of Malawi will impose requirements onto the commercial banks in Malawi to be able to maintain an asset liability mix that will be able to meet that projected cash flows or forecasted cash flows. Okay, so forecasting and monitoring, you should be able to monitor, for example, cash flow projections, and also monitoring, for example, liquidity needs and management, to be able to handle any shocks. And then that's where, after forecasting, then we can do a sensitivity analysis or a scenario analysis, a stress testing, to be able to see in case of shocks in the market, such as market crashes, bank run, and surge in withdrawals, what will we be able to handle that risk? Okay, so yes, is that okay now?
Yes.
Yeah. So in that case, if you, for example, if in that case, if you don't comply with the LCR requirement of the RMB, then one, you are there will be regulatory consequences, right, by the RMB, okay, because you are not complying with the Basel III requirement. And then what you will need to do in that case, you need to increase your capital buffers, for example, in cash and generally high quality liquid assets. Secondly, you need to, if you rely on short-term funding, like the bank, the Northern Rock, which collapsed, and also the bank, if you rely too much on short-term funding, for example, borrowing in the interbank markets, then during, for example, market crashes, you will not be able to meet the NSFR requirements that you should be able to. Your asset and liability mix should compose of stable funding, okay. And then, so now what should you do as the Treasury department of that bank? Then you should consider investing in longer term stable funding, generally stable funding instruments. For example, term deposits, you should do, for example, deposit promotions, also long-term bonds, things like 10-year bonds. You can diversify also your funding sources, not just concentrate your funding sources on one particular source of funding. And you can also even invest or concentrate your funding sources on different, okay. We have seen how to manage the different types of risk. In particular instances of LM mismatches, we looked at an example of for example, an hypothetical release or balance sheet of the, for example, we just took an hypothetical National Bank of Malawi, and then we saw how each risk was able to influence each particular mix. For example, if in the short term there is a higher mix of risk sensitive assets, then it led to, for example, a capital or interest rate gap of negative 50%. So in this case, should there be fluctuations in the currency and also in the interest rates, then we saw how we can hedge ourselves against that.